Welcome to the Mr. R Show, presented by the MRR Institute. This podcast is designed specifically for tax professionals looking to scale and modernize their practice by maximizing revenue through resources. Join us as we explore expert strategies, innovative tools, and actionable advice to help you navigate the evolving landscape of the tax industry. Whether you're aiming to grow your business or enhance your client experience, you're in the right place. Now, let's get to the show and transform your practice together.
Hey everybody, and welcome back to the Mr. R Show here, presented, brought to you, edited, and I guess hosted by the Monthly Recurring Revenue Institute. If you're not familiar with who Mr. R is, go back to a couple episodes. We actually take a little time and describe that. But I promise you, Mr. R has more hair than my co-host on this show, Chris Picciurro. What's happening, Chris? How are you, man?
John, thank you for the hair joke. It's always a must. And let's just mention pickleball right now and get that out of the way for this episode.
All right, good. We got all the boilerplate stuff completely out of the way. So
and then we can bitch about how language.
It's okay. We could beep that one out.
I don't know if I've ever sworn. We can complain about how high the taxes are in California.
Of course. We have to poke fun at California. And I know for a fact that we do have some listeners out there. So we do not apologize for that, because by choice, you probably live there. And there's 49, technically 50 other places you could move to. So let's just throw that out there. Anyways, so on this topic, speaking of making decisions, right, on where to live, today's topic we're going to dive into, we are going to really look and kind of compare and contrast and kind of walk the path, if we will, on buy versus build a tax practice. So, Chris, I'm really interested in this one. Obviously, sitting on we'll call it riding the pine, knowing you for so long, I see you guys go through a massive acquisition period where you guys were basically buying practices like candy bars at a grocery store checkout aisle. So I'm super excited to get into this one. And I know we brought on a great guest. And Chris, I'll let you introduce our guest on today's show.
Absolutely. Well, I'm very honored, both John and I, to have Matt Kidd with us today. Matt and I have known each other for a very long time in the Michigan Association of CPAs. Unlike myself, he also, and like Johnny, has a great head of hair. For those that are listening, Matt,
did you say great or graying head of hair?
Oh, I think it's
I'm
great.
Not sure which one, but
you could fix gray. But Matt is a CPA, but he's also a PFS like myself, personal financial specialist. He has an awesome journey into becoming a CPA, and he was the first person I thought of when inquiring about having a guest about this topic. Myself personally, and we'll start talking about this over the course of my 22 years of being a practitioner. I just added them up and bought 6 tax practices over that time. I'll talk about what we did with them in the future here. But I know that that's a classic debate when you're a tax or an accounting professional. Should you buy a practice or should you build a practice? And what makes sense? So I'm excited to have Matt. Matt, tell us a little bit more about yourself, and welcome to the Mr. R Show.
Yeah, thanks for having me. You did a pretty good job covering things, but like a little more background, I am the son of a CPA. So my dad was a partner in a large local firm for most of his career. I lived what I would call the traditional public accounting life. So very, very heavy tax seasons, worked hard, and they also did, throughout his tenure as managing partner, I think they did 5 or 6 acquisitions as well. So that was kind of the environment that I grew up in. Then for some insane to be determined reason, I decided to become a CPA as well. I think it's actually because I enjoy the boats too much, so I just needed a way to fund the boats and spend time on them.
Well, okay, yeah, you want to be on the water in the summer.
So became a CPA, bounced around to a couple of small firms after college, and then kind of hit the point that I was banging my head against the wall, saying there's gotta be a better way to do things than some of these traditional firms were doing so. So that was when I hit the point that my 2 options were I was either going to find a firm to buy, or I was going to go on my own, start from scratch, see if I could get some part-time contract work to pay the bills while I built up a practice. ended up having a firm that came up for sale. That was one owner, had one longtime accountant that worked with him, and ended up buying that firm in 2017. That's where the fun began.
So I'm going to take you back to, all three of us actually grew up in Michigan. When did obviously you grew up in a household with your dad being a managing partner of a firm, doing a lot of acquisitions. Did you feel the pressure to become a CPA? Did you, or what was your dad like, oh, don't do this? What got you thinking that you wanted to get into this field?
No, and actually interesting, I've got two older brothers and we're all CPAs as well. And I would say there was no pressure to become CPAs whatsoever. I wouldn't say there was a push for us not to do it either. I think we had very honest and open conversations about what the good and the bad of it was when I was early teenage years, all through high school. That was much to my mother's dismay, that's what we talked about almost every night.
You didn't talk about the Detroit Tigers?
Ooh, in that era, they were on the upswing. So we did talk about them. The last 10 years or so, not so much, unless, and we could talk about pitching, but we're not going to dive into the hitting.
No, we can't score. I always often say that Tigers can't score in a brothel with a fistful of hundreds right now.
I'm not sure how I was supposed to follow up with that one.
Yeah, say leave it to a tax guy or just a financial guy at all to come up with a joke like that. But you know what? I won't say we can all relate to that, but we can understand that.
Well, it's somewhat related, which is a dangerous road to go down, being related to that story. But my the desk that I have in my office, it actually came from the ex-wife of a CPA who lost it in the middle of tax season and ran off to Florida with a stripper.
Wow, that desk. Good thing adults listen to this podcast, and Lord knows what else has transpired on that desk. But
yeah, so I think I've got a little bad juju going with that desk. But
got a good story behind it.
So when you're
I never thought about that. Come on, man.
I'm talking that. I was just thinking about the desk being eligible for bonus depreciation. I don't know what you guys are talking about.
All right, so back to accounting.
Now, interestingly, I know you have two, like you mentioned, you have two brothers. I've gotten to know one of them. They're both CPAs. Are both of them in public accounting, or what are they up to?
Yeah. So we each have our own separate small firms. There was a period when we first bought them, we were all one corporation. Because we were able to save money on the software and insurance being the main things. So it saved us quite a bit of overhead when the cash flow was tight for everybody. Once we kind of got to the point that the cash flow was solid, it was more headache than it was worth, all being in one corporation. And we always ran basically separate firms, despite being one corp. So we split it apart probably 3-4 years ago, I'd say. It was during COVID, so whenever that 5-year stretch happened.
Yeah, that 5 years. Well, yeah, that was interesting. That's for sure. Although I think that in my 22 years, other than obviously people getting sick from a business perspective, it's probably one of the best things because for a lot of practitioners, it forced them, pushed them, shoved them into the 21st century, where some of them don't like to step foot in. But well, that's cool. So did you have any jobs previous to, going to school for accounting that you feel like you got to learn some entrepreneurship or anything about tax finance?
Well, my first job, and I don't know, don't report me to the ethics committee, but my first small business was I ran NCAA tournament brackets in grade school. And it was back before the days of ESPN.com. So you had to hand grade the paper brackets. So I took a commission of the pool that I ran. And then the second year
What high school did you go to?
Oh, this was starting in 6th grade. I was doing this.
Oh, in 6th grade.
Yeah. At a Lutheran school. I was. And you had to talk, that was a lesson in disrupting business models. Because by the time we hit high school, electronic brackets were a thing. And I could no longer take my commission because you could just have it graded online.
You were like a lunch table bookie.
My first real job was a Detroit newspaper boy, and that has been completely disrupted. I'm older than both of you, so I would drive my bike around like the video game and have to go to strangers' houses, collect money. I had my own, I had to buy the papers wholesale, so I had a whole business, a legit. My business was legit, although, you know, I don't know if all my income was reported properly as a 12, 13, 14-year-old kid, but we'll move on from that.
I did legitimately work as a lifeguard and bar cook.
Nice.
For a while.
And were you in the Detroit area growing up, or outside of Detroit?
So actually I grew up in Frankenmuth. Obviously you're familiar with it, but for those of you not from Michigan, little German tourist town that's Christmas 365 days a year, and you can get fried chicken for breakfast, lunch, and dinner.
Yeah, you can go to Bronner's and get a Christmas ornament anytime. I know it's a lot of fun. We stop up there when the family's up for once in a while because the kids enjoy it. So here's another thing I did pick up on is you didn't work at your dad's firm then when you first did. Your dad say, look, you got to go out, get your CPA license, work at other places first, then we could talk? Or
so I did. I worked part-time there when they were again, I mean, business models evolving, when they were scanning all of their old paper files. So I was 14 or 15 when they were doing that. So I'd ride into the office of my dad and I'd scan, me and the other partner's kids would scan the old paper documents in the file cabinet at the time for 10 hours.
Wow.
I'd go home and do it again. But then didn't work there after graduation.
And is he still practicing, or is he turned in his mouse and keypad?
Yeah, so he's still very part-time working. So he spends January and February in Florida, comes back to Michigan in March and works March, April with basically his old longtime clients that he's kind of slowly retiring as they also retire and die. But no, I refer to it as first career and second career, because part of the going the small firm route was he hit 55 and he was burned out.
Okay. Yeah.
So he took a early buyout from the firm at, I don't know, he was 55, 56 years old, worked part-time for him for a couple of years. And then that was actually my oldest brother was at the time working for a school district, but he was doing taxes seasonally for a firm out of Saginaw. And he was the only other CPA that was at that firm besides the owner. Owner approached him about buying the firm. Original thought was it'd be a normal internal transition where it would take a 5-year transition period. But it just so happened that at the same time, my dad was getting a little tired of being an employee after being a partner for 35 years. So he said, well, if you want to make this go a little faster, we can. So then he went in with my brother to buy his first firm probably 8 years ago.
Okay.
I would say. And then that was when he went from, and that was a high volume 1040 firm.
Okay.
So he went from working on larger complex businesses to learning how to do 300 1040s in a tax season. So then that's basically it's been, so 8-9 years now. I'd call him a consulting role in our firms. That he lets us screw up, but then he's there to help us figure out how to fix it.
Oh, that's cool, man. So obviously you it's similar to myself. Like I was working at larger CPA firms, went to corporate America for a little bit because they were nice enough to pay for my MBA. Then just kind of was like, I just want to do my own deal. So I started my own practice. My parents thought I was nuts. In my spare bedroom, I made sure I bought a condo and a car first because I knew I wouldn't get any credit for like 3 years. In August, I started a practice, and then in November, I ended up buying a practice. So tell me about that first acquisition, and then I want to talk through, tell me about the first acquisition. Then I want to talk through, just as we talk about buying versus building, the advantages and disadvantages of buying a practice.
Yeah. So the first acquisition, I mean, one of the key things was I needed somewhat of a long-term transition, because at the time I was 26 when I closed on that first practice. So I may have thought I knew what I was doing. The truth is I didn't know what the hell I was doing.
Right.
So we were looking for a firm that, you know, the seller was looking for at least a 2-year transition. Found one that he was actually looking to do a 5-year transition that we had set hours each year, and it was a step down of hours.
Okay.
So started out with 1,200 hours, 1,800. He comes in, does tax prep and tax season.
Oh, so it's a success story. Nice. Well, it's funny. I was 27 when I bought my first practice, and I agree. I didn't know, but I kind of just figured it out in some ways. And not the most efficient, that's for sure. But and so, do you still have a lot of those clients now? I mean, that was
we do. So we're now at the point that we're considering the possibility of starting to deconstruct some of the firm, kind of to be determined, but we're looking at selling off some of the old model potentially, or just referring them out to other CPAs that they're now ideal clients for, that they aren't necessarily for us anymore.
I'm going to steal the deconstruct term because I love that term. I use the term. So we divested about 96% of our clients and at a crossroads. And this was about 8 years ago, something like that. We kind of started on our membership-based model 12 years ago, and then ran parallel for a little bit, let people opt into it, and then eventually divested it out. So I don't know. It's a toughie. I think if I had to do it all over again, it's tough to say. I don't, but I would consider, and we did this a little bit, but I would consider, even if it's within the same entity, I would consider creating a separate brand that's the new clients come into, and then the what we call legacy clients are in the other brand, and they can jump into the new brand or the new way. That, let's say if it's subscription, or let's say it's, you're only going to do tax prep for clients that you do planning for, either tax planning or financial planning, or it could be that you're significantly pivoting and increasing the minimum fee that you charge, but you get certain other things. You could do that, just like, we've all probably know someone or been a part of something where you're in some type of membership. It could be a timeshare, it could be something, and they realize, like, this is not very profitable. So we're going to create a premium product that you can trade into, or you can
please never compare us to timeshares again.
I should say vacation clubs.
Anything else.
Well, the reason I know I don't like comparing us to that, but
I don't think I've ever met someone who has tried to stay in a timeshare.
But there's a lot of parallels though. That's because then they'll come out and they'll say, so think about like when Marriott bought Sheridan or something. They have to grandfather people into one of the memberships, or whenever you're trying to create a premium service, or you're trying to get your service, and you're changing your model. Sometimes, it's easier just to start fresh and then either deconstruct or shift those people and pivot those people into the new model. So that's challenging though, because I could just tell you, emotionally for me, it was very, very challenging, because at 27 years old, for someone to put their faith in me to prepare their returns, and we weren't doing a lot of the ancillary services that we do now, and again, that was 22 years ago. I felt such a gratitude towards them, and it took me a long time to convince myself that I'm doing them a disservice by really running my business one way and having all these outliers or exceptions the other way, and they deserve to have someone that's better aligned with what their needs are, because my heart really wasn't in it at that point, and that's hard. I don't know if you're going through any of that.
Yeah, to a certain degree, where I think one of the best and worst things about buying versus building your own is you're forced to manage a lot of staff with clients, because generally, especially if you're buying a firm on the open market, it's usually getting sold because they couldn't find anyone else to buy it. They're on a legacy software that's about to end support. I mean, that was ours. They were on CSA, the old Thomson Reuters. That support was ending. And so I had, from the day of closing, I think I had 60 days to convert all of the clients out of CSA, which is generally like a 1 to 2 year transition.
Wow.
So it is absolutely drinking from a fire hose that I say it's good and bad because I absolutely learned a ton. I would absolutely do it all over again because of what I learned.
Right.
So I mean, now when issues come up, it's pretty darn easy to deal with them because they're easy compared to what you had to deal with up front. Now that said, I mean, it was a wild amount of stress and anxiety when it occurred, but I think the perspective helps a ton now. Where I mean,
Right.
I think we implemented SurePrep this year. We didn't start implementation until about January, so we got SurePrep up and running in about a 3 to 4 week span. And again, I don't recommend it. It was an insurmountable lift because of what we had to previously do.
Yeah, you had to do it. And so you made a great point that I want the listeners to understand. And I know we're talking and having fun, but when you're thinking about buying a practice, our niche in our private CPA practice are real estate investors. And real estate investors understand that they make money when they buy property. When they sell it, it's just a transaction. They also understand, and if you have clients that are real estate investors that don't buy things off MLS. Okay, so when they buy things wholesale, they buy things from distressed situations, they buy things from other people in their network or previous relationships. So if you're buying or selling a practice that's listed publicly, then you're buying, let's put it this way, it's getting listed for retail. That doesn't mean that's the price. And there are a lot of considerations. I have some strong opinions about buy versus build at this point, which I'll talk about later. But the thing is, you've got to understand that, right? And you put it perfectly. There's a reason that someone internally didn't buy the practice. My personal opinion is I think an internal transition is probably the best option by far for clients, for the people involved. And that's ultimately what you did with the first practice. The person stayed on and was retained, and that person still is part of your team. So obviously it was nothing's ever smooth, we'll say, but it was a very good situation if he's still retained. Have you purchased any other practices since then?
No, because what I'll say to that is that it's smooth now. The first year or two, I mean, you particularly when you're dealing with sole proprietors that have been doing it for 20, 30 plus years, and I'm included, we've got strong personalities. I mean, there's generally a reason we don't have partners. So you're going to have clashes. If you're buying out a sole owner and you're going to be the sole owner, there's going to be clashes. Because if you've been doing something one way for 30 years, you're dead set that that's the right way to do it.
Well, let me ask this question about, and we don't need to use numbers here, but when we're talking about how many years ago did you buy? Was that 2017 when you purchased the practice, or my?
Yep.
Okay. So
September 1st, 2017.
Okay. So we're about 7 years in. If you looked at your not percent of revenue, but percent of clients, what percent of clients do you think were part of that practice versus new clients? I mean, 30,000 foot view, would you say?
So I would say we probably have, of those original clients, we probably retained, I would say 60% at this point.
Wow, that's phenomenal.
And I'd say most of those who have left were retirements on the business side of things. Because I knew it was an older client base, which, I mean, we were churning out the last few years somewhere between 3 and 6 business clients a year that retired. Then on the 1040 side, I don't track that quite as well because I look more at the total number and the average revenue. So we're down about 100 1040s from what we were when we purchased it. But the average revenue on those 1040s has gone from, try to keep your jaw off the floor. It was $170 per 1040.
That's it?
We've now got it up to about $350.
Mm-hmm. That's phenomenal to think about. You've been able to basically double the average price of your 1040s, and you're doing a lot less. I think that we'll all agree, most people agree at this point that the 1040 turn and burn model is not sustainable. You're going to have to do other things. It's like being in a street gang. You're going to end up in instead of in jail, you're going to end up in the hospital or dead. That's just one of those things that you can't sustain. It's like a bridge that's going to break at some point. It could cost you relationships. It could cost you health. It's going to cost you something. And unfortunately, I was down that train for the first, solid 5-6 years of my practice. And yeah, it gets scary. So congrats to you. Now,
the 1040 mil, I refer to it as a drug addiction, because like you start out and like if it's just you, if you're the one doing the 1040, you're like, man, I'll do a 1040 for $200. It takes me 10 minutes to do. Like, this is easy. It's free money.
And
then you get busy and you're just like, oh man, this is killing me. I'm going to raise the price. I'm going to say $300. No idiot's going to pay me $300 to do their 1040. Then all of a sudden you do it. You just kind of took a step up from marijuana to, you just kind of took a little snort of cocaine at that $300. And then next thing you know, you say you're going to do a 1040 for $600, and you're just mainlining heroin, working 85 hours a week, cranking out little old ladies 1040s.
Absolutely. Yeah, it is kind of like a drug too, because Matt, for me, I was only 27 when I started. You were 26. I know things are ridiculously priced now, but for me, 22 years ago, for you, 7 years ago, to sell someone, I'll give you $150, and they come in to do a 15-minute appointment, and they're signing their $88.79 and out the door. And that's, and you're thinking to yourself, okay, well, 4 of those could pay for my car a month. You're just in your mind, you're kind of doing that. But that's how a lot of us start. That's
where I think, a big thing is that, not all of your clients are going to grow with your practice. And it's okay to, what used to be a great client for you may likely become not a great client, but they're going to be a great client for somebody else.
Absolutely. And another thing to consider, and I've done a lot of breaking up with clients either one way or another, in what I feel is like, I feel like they're getting left better than we found them, and there is someone for them. And guess what? If you think you're not the best fit for them, they probably feel the same way too, but it's scarier for them. So if you can find, like, as you deconstruct, Matt, if you do decide to deconstruct part of your practice, you're not going to leave these people high and dry. You're going to find someone that can really fit their needs. But we have, as you well know, such a pipeline issue in our industry. It's going to be challenging. It's challenging to find the right people. But let's talk through buying a CPA firm or buying a tax firm, accounting firm. The advantages are obviously, the biggest advantage is you have a revenue stream. Now, you might not like that revenue stream, but you have one. Potentially you have an established brand. You might not like that brand, but in some places that might have some value. I kind of think the value of a firm has been decreased significantly unless you're on some type of value price or subscription model. Yes, I'm biased, but that's just, to me, the number one advantage on top of the revenue, because I don't think revenue is that hard to find, is, does it come with someone that you can add to your team? I think the human capital is the most precious resource right now out there. Yeah, an advantage that could come with operational systems, but as you alluded to, if you're buying a practice from someone that's, let's say, 65 years old, let's say they've owned it for 40 years, typically no way their operational systems are going to evolve over the next 40 years, right? That's probably not going to happen. So it might take some tweaking, and it might take some shifting over, especially if your firm is acquiring a larger firm, meaning not necessarily revenue, but number of clients. So that's something to consider. And what pivots have you made to any type of operational systems that you kind of, with the old firm? What's like one or two major things that you tweaked that were big game changers?
Yeah. So, I mean, I'd say I was very fortunate in that the firm already did monthly or quarterly bookkeeping for the vast majority of the business clients. So it was I've always got a back and forth debate on whether CAS is a real thing or whether it's just rebranded bookkeeping.
Right.
But we've been doing bookkeeping and bill pay since the beginning of time. So for us, it was when I bought it, the bills were going out when the work was completed. So one of the first shifts that we did was just switching that to a recurring billing, which was a fairly easy transition because
right,
you always have a little bit of pushback. For the most part, people liked it because it was consistent. And then we recently, last year, we finally forced everybody on the ACH. Before it had been voluntary. So we finally forced them all on the ACH.
All right. I love it.
A couple of them said no, and we said, well, you can either go on or go off. So it's your choice.
You know what? Usually when that's a tough, we've been on ACH also for quite a few years. And the dirty secret is, like, if you're a practitioner and you want to implement something and the client's not willing, 99% of the time, they're kind of the people you don't want anyway. So it solves a problem potentially. Didn't mean to interrupt, but that's just what I'm thinking.
Yeah. Yeah. Then I'd say, I mean, the other things we've done these slow incremental price increases. So we've never done the double the prices, anything like that. We've done basically 10 to 20% a year. But then the recent pivot that we've done is we opened up an RIA to offer financial planning and wealth management to the existing client base. So we're not marketing it outside of the existing base at all. It's just a new service offering that we're reaching out and talking with all of our 10 to 40 clients about.
Well, that's what I want. A great segue to my next thing is we're kind of talking through the disadvantages of buying a practice. You know, obviously the cost, right? So there's going to be a note. Typically, you're going to either get an SBA loan or there's going to be some type of seller financing, or it could be an earn-out contingency. But ultimately you're paying for that book of business. So you've got to, if you buy a book of business, in my opinion, you either have to raise your rates significantly, which hurts retention and could actually hurt your contingency costs if it's based on a contingency, or you need to introduce extra lines of services, which I'm going to circle back, but you've done a brilliant job of. Again, every practice has its own culture, and that could be a good thing or bad thing. It's just like, look, we've got leaders, every team has a leader. Leadership isn't always good. It could be a bad leader. So the firm culture is going to be set by either the core of the team, or it's going to be set by the clients or someone that's unhappy. Obviously, there's a retention risk. In my opinion, in buying all these practices, and I'm going to use it, deconstructing them. Clients in general, I mean, think about if your dentist emailed you or called and said, "Hey, I'm retiring." The dentist, is taking over the practice. You're not going to just change unless you had a reason to change. You're probably going to go there and see how it goes. So I think the retention risk, if you do a good job, is going to be high. Your retention at 60% now after 7 years is very, very high. Obviously, there's hidden liabilities. Now, typically when you buy a book of business, you're making an asset purchase. You're not buying their entity. But hidden liabilities are, and Matt, I'm sure you ran into this. Well, and you had the person that sold the practice on your team, but let's say you bought a practice from a guy named Joe. Well, Joe did all my IRS notices and didn't charge me. Joe met me on Sunday and had 2 cups of coffee with me so I can give him my W-2 and one 1099. So there's those, when I say hidden liabilities, there's some what we call scope creep out there. I don't know for certain clients. Do you run into that?
And I would say, so my argument is actually it's more difficult if the seller is sticking around.
I love it. Okay.
With those liabilities, because he'll continue to do those things unless you decide it's a battle worth fighting. And that's where, I mean, with with that, I mean, you have to pick and choose the battles on which ones are worth it. It's your line in the sand. Which ones don't really matter because it's not you that's meeting with them on a Sunday. That if they're willing to do it, they can do it. And I've been very clear that I won't do that sort of thing. And I've gotten more and more. I used to do.
Right.
I used to be willing to do it.
Absolutely.
As I think pretty much everyone is when they start. I mean, you do stuff that you look back and you're like, me.
Yeah, no, I know what you mean. For me, if it was legal and they'd pay me, I would do it.
Yeah, if they wanted me to wash their car after I did their 1040 for $7.50, I was out there shining that baby.
I'd probably do it.
But then, I mean, I think as you evolve, I mean, you just learn to set more and more boundaries. Whereas the last 2 years, this year even more so, I had in pretty heavy time blocks in tax season where I wasn't available for appointments at all. It was just time to work on specific things. Because before I'd open it up all day, and I mean, if you've got an appointment at 9, you get it done in 45 minutes, then you've got a half hour to the next appointment. You can't do anything in that half hour.
Yeah, no.
I mean, that's maybe answer some emails, but then you're twiddling your thumbs because the next meeting shows up 5 minutes late. So that was the big thing for me is, I mean, we just putting in those time blocks so that all those appointments are running back to back to back.
John's getting excited over there because, shameless plug that Matt's in our Mr. R Tax Pro 2.0 mastermind group, and time blocking is, you got to say no to say yes. Like time blocking is one of the biggest hacks us tax pros need to use, because as entrepreneurs, we think in our mind, like, I don't want to block time because I want to be able to be free. When you block time, you actually free yourself up. That it's a hidden secret. That's very wise of you. I used to do it, man. I had no control over my calendar. It was people were booking stuff, and now I, with some technology, with some work, you can really look at your calendar and remember, you need to manage your practice. You don't want your practice managing you. And that comes down to anything outwardly facing and you having control of it. Well, let's talk about building a firm.
No, I was on the scheduling. I'm glad you caught my calendar link when you went to go book this, and I was available on Saturdays. Thankfully, no clients had taken up that option since I forgot to change it after tax season, but
I should have sent it to John. He likes to make fake meetings on calendars and test them, and he'll have like the Jerky Boys or some random fictional character in on it.
I get pretty creative with the names, right? Now I just need to step my game up and get creative on the topics.
So here's the advantages of building a firm. And obviously, I think a lot of times, it depends on your age. It depends on a lot of factors, but you can really build it in your own image. We talk about a lot as practitioners that your practice is going to run exactly how you designed it. So if you don't like something, you might take this the wrong way, but that's your problem. You designed it. If you're allowing clients to do certain things and you've designed your firm to allow for that, so you've got to pivot that. So it's easier, way, way easier. And you kind of talked about that. If someone does stay around and that sells a practice, if you have a vision, you can build it in that vision, because it's going to be almost impossible to take someone that was something that was someone else's vision and get it into your vision. And that's very challenging. I mean, obviously becoming a CPA firm, tax firm, whatever, accounting firm really doesn't have a ton of cost. It's not like you have to go buy a manufacturing facility. So low initial costs, you can grow at your own pace, which is nice. If you design it right, you could have a lot of flexibility. And you can, quickly implement any type of practice management changes. And you remember that your clients chose you, you chose your clients. It wasn't an arranged marriage. Because when you buy a practice, now arranged marriages work out sometimes, but sometimes they don't. Obviously, the disadvantage, a lot of time consuming figuring processes and structure and technology out. Now, again, if you're buying a firm or buying into a firm that already has that established, that's great, but most of them are very antiquated. Whenever we come to our conferences, it shocks me how many people don't have any of their apps in the cloud. It's just scary. It's a little higher risk, I guess. I don't really think there's as much of a risk because I think there's so many potential clients out there. You might not have a brand, and there's a little more uncertainty. But I mean, the building. So I'm going to talk about kind of tie in building because, man, you've bought a practice, but you also built a practice in a way too, right? You've got your clients that you've brought on, and you mentioned, like, what are some of the differences in dealing with those clients versus clients that were part of the practice that you purchased?
So you've got, again, on my practice purchase, I was very fortunate in that a lot of the clients were already bookkeeping clients. The accountant who handled all of that bookkeeping is still with us. So I say that relatively runs on autopilot. I deal with the tax side, but she does great with the accounting side. I know the financials are right. So all I've got to do is glance at them to see if there's any tax planning issues that I need to be aware of. But it is kind of out of sight, out of mind. The new clients, I would say I'm more involved in. So I'd say probably half of them, we have some form of advisory built into the monthly agreement beyond just the accounting and tax planning. So I'm interacting with them much more. It is more active. Now, the flip side is those new clients, they're at about 2.5 to 3 times the revenue of what the per client legacy is.
And that's a point when thinking about buying and the value of a practice, the more sticky your services are, bookkeeping, payroll processing, those are pretty sticky. Memberships, like where you're integrating tax planning and strategy or financial planning, are super sticky, where a 1040 only practice is really a commodity ultimately. And you were able to increase the price points for those newer clients that you brought in versus what we call legacy clients. Let's talk a little bit as we wrap up. Let's just talk a little bit about, if you're going to buy a practice, and I mentioned this, I just don't want to forget, and I don't want to upset anyone, but just my personal opinion, where I'm at in my life and where all my practice is, I would not buy a practice and I would not take one for free. No offense, unless it came with like 10 A+ team members. I just wouldn't do it.
So I'll cross you off my potential sale partners. But
yeah, probably. But we can make it look really pretty for someone else to sell it, to buy it.
And I think it's important to acknowledge that we're in a very different environment than we've traditionally been as tax and accounting professionals, where there's not enough supply of us. That traditionally that hasn't been the case. And I mean, the advent of social media and online learning, you can now follow a bunch of people and learn how to build your firm from scratch, how to do online marketing, that even 7 years ago, those resources weren't readily available. If they were, it was through a consulting organization you had to pay $10,000 plus a year to get to, that you couldn't afford as a startup. So I think, in the buy versus build question, in the current environment, I think building is a more viable option.
I would agree.
Than buying. 7 years ago, I would say buying was a better option.
And I agree. And I think that, the one asterisk I might put in there is, if you are already in an organization and you have emerged into leadership, buying into the business, buying in as a partner, I think is very viable. I look at that as not really you're not really buying a practice. You're really more coming into a partnership, if that makes sense. So I don't want anyone to think like that you should never buy or sell. That's just for me. We're trying to, what we want to do in our practice is layer leadership and have people come through that could be equity partners down the road. So one more thing I want to touch on is, as we wrap up, is if you do buy a practice, you can't just stay status quo. Because the numbers just aren't going to work, really, because you're going to have to service debt. You've got to probably either have the capacity to bring on new clients or be able to implement new services. And Matt, I know you're a PFS, personal financial specialist, right? Yeah. Yes. And I should know that. You have to implement that. So in general for you, has it been easier to implement new services to the legacy clients or to the clients that you've already, the newer clients? Because a legacy client might be excited by it. Like, oh gosh, I've been doing this for 30 years this way and now they have this.
Check back with me in 3 months after I'm done reaching out to all of the legacy clients on financial planning.
All right, sounds good. That'll be a good follow-up.
But no, I mean, I'd say definitely from the new clients. And I'd say more so it's not I say it's easier on the new client side because the new things we've implemented, they don't have the option of the old way. When they come on, they're doing it the new way. I mean, we don't have, you can't drop your documents off.
Right.
You can't come in and sit down and watch me do your 1040. You're going to upload it to our portal. We're going to do it electronically. I'm going to send you a Loom video review. And if you want to meet beyond that, we can set up a consulting meeting after tax season.
I love hearing about Loom. I've been advocating that for a long time. But yeah, that is great advice. And we need definitely, I wish we had more people like yourself in our industry right now. And I love what you're doing. I really enjoyed getting to know you even more. And you've not only, with your clients taken on leadership, you've taken on leadership positions within our industry too. So that's very refreshing.
And Matt and Chris, I have to almost be the grim reaper of timekeeping here. I know this is a topic we can go on forever about. And I'm looking here again as I'm over here scratching down notes on my little fancy blue stick-it notes, and I stick them up on my wall every once in a while about things. And honestly, to wrap this up, one thing, I do apologize, but I do have to cut you off because we can go down a whole rabbit hole here in comparing them. So,
I mean, I was trying to run extra so we could cut out that broth.
No, we're leaving it.
Oh, we can.
we are leaving it. That is fantastic. And honestly, I mean, from the outside looking in, and Chris is always hearing me talk about this, right? Like me not being a tax pro, but through the professional osmosis, we call it. I love hearing everything that goes on in y'all's world. Some of it I do not envy. Let's just be clear about that. Some of it's pretty interesting, and it's very interesting to me to see the divide between those that are very, very pro-buy and those that are very, very pro-build. And I would say almost, again, outside looking in, it's almost, I wouldn't say the drive, the motivation behind the individual, but just the personality, right? Some people like the idea of going in, buying a book of business and building on that versus putting it all on the table, building it. It's more of a gamble, more of a risk, and doing it from scratch. So on that note, Matt, we're going to have you back, man. It's not up to you. We're going to have to have you back on the show and dive into this.
I mean, we didn't even go down the rabbit trail of buying and building for the sale to PE, which is a whole new entrant that, I mean, they're getting into small firms
exactly
now.
What I'm talking about, right? So we
will go, we're going to come back and revisit this. And actually it'd be great to, especially let's get some more data points with your practice. But yeah, I hope, anyone listening, there's no right answer for everybody, but I do like the idea of at least building to start, try it for a few months and then see. Because you could always buy, but it's very difficult to unbuy.
Very expensive to unbuy. But thank you both, gentlemen. I know your experience in this on both sides of the fence. And obviously us all being associated by being Michiganders always helps out. Maybe makes us a little crazier than most, which is fine. Which is great. Awesome, gentlemen. Well, I appreciate both of your time on this. Chris, obviously you're here by obligation. I do not let you off the hook ever on this show. But Matt, thank you so much for carving the time out of your day. I know we're post the tax deadline, so it's a little bit easier to get you on the show. And we appreciate it.
Appreciate it. I had fun. Plus it's cold and cloudy today, so I'm not going on the boat.
Hey, it's a good reason, and we'll take it. So that
all right. Next episode is going to be in boating versus pickleball. Better hobby.
Lovely.
Oh, one of those I can drink beer during. So I'm going to.
Well, we have a beer league and pickleball. So and then I know we ran over on time, but we have once a month we do beer league where it's a round robin. It's for fun, and you have to play with a beer in one hand and a pickleball paddle in the other. If you play the first game, if you spill the beer, you've got to chug it, and you lose a point. And then you do this, and by the end of the round robin, it's pretty interesting.
That is my kind of pickleball, as long as I'm playing with other amateurs. Otherwise, it's just going to end very poorly for me.
And hopefully at the end of that match, you're not trying to decide whether you're buying or building a tax practice, because it's all downhill.
Well, by the end of that match, it'll probably seem like buying was a good idea.
Right.
Yeah, exactly.
All right. You guys in your boating and pickleball references. I'm out of here. Thank you guys again for your time. And thank you for everybody who's listening to this here on the Mr. R Show. Be sure to hop on, get your CPE. This is going to be posted on Earmark as well as across the board. We put the links directly in the show notes, as well as a link to some of Matt's profiles as well, so you can harass him on some of his references. So that being said, we will see everybody back here next time on the Mr. R Show.
You've been listening to the Mr. R Show, presented by the MRR Institute. For more content like this, be sure to check us out on YouTube for weekly expert tips. And don't forget to subscribe to this podcast to stay updated on the latest strategies for scaling and modernizing your tax practice. Looking for more? Contact us at mrrinstitute.com for practice resources, coaching opportunities, and a peer-to-peer mastermind group. Thanks for joining us, and we'll see you next time.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.